In Britain today, more than 1 million pensioners are facing a new and unexpected tax bill. These aren't people with huge stock portfolios or luxury assets. Many are simply older savers with modest nest eggs who have suddenly found themselves paying tax on their hard-earned savings. The cause? A combination of high interest rates, frozen tax thresholds, and a possible shake-up of tax-free accounts that could change how millions save for retirement. Let's break it down to what's really happening. More than 1 million pensioners will pay tax on their savings this year, figures from HMRC have revealed. The number of pensioners facing tax bills on their savings income has more than doubled since 2022 to 2023 due to high interest rates and frozen thresholds. Those over the state pension age make up nearly half of the 2.6 million taxpayers expected to pay savings tax in 2025 to 2026, according to official figures. First, interest rates have soared since the pandemic. While that's good news for savers earning high returns, it also means they're earning more taxable income. The problem is that the thresholds that determine how much of the income is tax-free haven't moved. They've been frozen for nearly a decade. As a result, many pensioners are now earning enough interest to cross those limits and face a tax bill. Put simply, the government hasn't adjusted the rules to keep up with the economy, and pensioners are paying the price. Those over the state pension age make up nearly half of the 2.6 million taxpayers expected to pay savings tax in 2025 to 26. That means around 1.2 million pensioners will now be taxed on interest from their savings. Of that group, about 80,000 are expected to pay the top rate of 45% of the interest they earn outside tax-free accounts like ISAs. Just 3 years ago, that number was 33,000. So in less than half a decade, the number of pensioners paying the highest possible rate on their savings has more than doubled. At the same time, basic rate taxpayers, those earning lower or middle incomes, are also being hit. Pensioners make up 2/3 of this group, with over 731,000 expected to pay some form of savings tax this year. It's a stark shift in Britain's saving landscape. Since 2021, the Bank of England has raised interest rates multiple times to fight inflation. For savers, that means their bank accounts now pay more in interest, sometimes 4% or even 5%. But for the tax system, it means more people are pushed over the personal savings allowance limit. That limit is crucial. For basic rate taxpayers, the first £1,000 in interest is tax-free. For higher rate taxpayers, it's just £500. And for the highest earners, there's no allowance at all. Yet these thresholds haven't changed in 9 years. Meanwhile, average savings rates have gone up 5-fold. As a result, even those who aren't rich are finding themselves hit with a bill. A basic rate taxpayer with £20,000 in a savings account at 5% interest now earns £1,000 a year in interest. Anything above that is taxable. It's not hard to see how quickly the system can pull ordinary people into paying more. As the Telegraph article explains, interest rates have soared since the pandemic, while tax thresholds remain frozen, pushing more savers over the tax-free allowance. It's a textbook case of fiscal drag. While inflation and economic growth pull more people into paying taxes, even if their real wealth hasn't changed. Adding to the uncertainty is the upcoming 26th of November autumn budget. Reports suggest that Chancellor Rachel Reeves is considering cutting the annual ISA allowance from its current £20,000 limit. If that happens, it would mean Britons could save less money each year in these tax-free accounts. The Telegraph reported that a senior Labour source confirmed that the ISA changes were being considered again ahead of the budget. Earlier in the year, an announcement on the future of ISAs was delayed after backlash from building societies who argued that changes could increase mortgage rates. Right now, there are 4 types of ISA: cash, stocks and shares, lifetime, and innovative finance. Cash ISAs are the most common, holding around £300 billion in total. But any reduction to their annual limit could have a big impact, especially on older savers who rely on these accounts to protect their cash from tax. In April, savers poured a record £14 billion into cash ISAs, the highest monthly deposit since 1999, driven by the fears that the government might soon restrict them. The concern is that if ISA limits are cut, even more pensioners will end up paying tax on their savings interest. This issue also highlights a general divide in Britain's financial system. Older savers, especially those in or near retirement, tend to keep more of their money in cash. They're less likely to take on investment risk and more likely to want stability. Charlene Young of investment platform AJ Bell, which submitted the Freedom of Information request, said, "In retirement, it is common to hold a little more cash. People often want to de-risk some of their investment, and those with a good handle on their spending needs might look to build a cash flow ladder or funnel to match what they've got planned for the next few years." Unfortunately, that appears to be leading to a large number of pensioners suffering a tax bill on their cash savings, with increased numbers being dragged into higher tax bands too. But this cautious approach, which once made financial sense, is now being penalised by the tax system. High interest rates are making savers look wealthier on paper, but in reality, they're no better off. Inflation has eaten into purchasing power, energy bills have risen, and many pensioners rely on fixed incomes, yet their increased interest earnings are being treated as taxable income, even if they don't feel necessarily richer. For many pensioners, the change isn't just financial, it's emotional. After decades of saving, they feel they're being punished for doing the right thing. These people who followed the advice to save for retirement, to live within their means, and to avoid unnecessary risk, now the combination of high rates and frozen thresholds has caught them in a trap. Anna Bowes of the Private Office summed it up. The people who are wealthiest and have probably got the most in cash savings, one, because they've been saving their whole lives, and two, because they've reduced the risk of their portfolios so they have more in cash. Then the freeze in the personal savings allowance will mean that they are being dragged into paying more tax than ever. Many pensioners are also worried about the future of ISAs. If the government reduces the allowance or limited access, their ability to protect savings from tax could shrink even further. For those living on tight budgets, even a small tax bill can make a big difference. From the government's perspective, the surge in savings tax payments is generating significant revenue. HM Revenue and Customs, HMRC, is expected to earn more than £6 billion this year from savers, with the average saver who will pay tax receiving a bill of £2,300. This is up from just £1.4 billion in 2020 to 2021, when only 800,000 were hit with a tax bill. So, in just 4 years, the number of people paying savings tax has more than tripled, and total revenue has more than quadrupled. That kind of fiscal boost is difficult for any government to ignore, especially at a time when public finances are under strain. But critics argue this amounts to a stealth tax. By freezing thresholds rather than openly raising rates, the government can increase tax revenue without technically changing tax law. The result, however, is the same. More people pay more tax. Rachel Reeves faces a difficult political and economic balancing act ahead of the November budget. On one hand, she has promised not to raise income tax, VAT, or national insurance, the three major levies of taxation. On the other hand, she needs to find billions to fund public spending and reduce debt. Targeting savers, particularly through ISA reforms or frozen allowances, offers an indirect way to raise revenue without breaking explicit tax promises. But it also risks alienating older voters, a key demographic in British politics. Older voters are some of the most active and outspoken people in British politics, and the Labour government learned that the hard way during the winter fuel payment controversy earlier this year. When ministers decided to limit who can claim the payment, the reaction was instant. Pensioners, angry letters, critical headlines flooded in from pensioners who felt let down. It was a clear reminder that upsetting older generations can quickly turn into a political crisis. Pensioners don't just speak up, they also show up to vote, far more than younger people do. That makes them one of the most influential groups in the country. A spokesman for HM Treasury said, "We are committed to helping our pensioners live with dignity and respect. Thanks to our commitment to the triple lock, millions will see the pension rise by up to £1,900 this Parliament. We will also protect the cash savings that are important for many pensioners who have put money away for a rainy day. But the Chancellor has been clear that she wants to get Britain investing again, so British companies can grow and British savers who choose to get more in return. That message highlights the wider goal, redirecting some of the nation's savings away from cash and into investments that support the economy. But whether that goal aligns with the financial reality of pensioners trying to preserve their savings is another matter. To understand the bigger picture, we need to zoom out. The UK's personal savings allowance hasn't been updated since 2016. Back then, savings accounts were paying less than 1% interest, so the £1,000 tax-free limit was generous enough to cover almost everyone. Fast forward to today, some savings accounts pay 5% interest or more. That means even modest balances can exceed the allowance. For example, someone with £20,000 in savings now earns around £1,000 a year in interest, the exact amount of the allowance. Add just a few £1,000s more and they would owe tax. For higher rate taxpayers, the threshold is even lower at £500. And for those earning over £125,000, there is no allowance at all. Unless their money is in an ISA, every penny of interest is taxable. The problem isn't just the frozen allowance. Inflation means the real value of that £1,000 has fallen significantly since 2016. In today's money, it would be worth about £800. So pensioners are not just paying more tax, they're paying it on a lower real threshold. The timing of the issue isn't accidental. The government faces a challenging fiscal environment with rising borrowing costs, slow economic growth, and pressure to fund public services. Raising traditional taxes would be politically risky, so the Treasury is looking for indirect sources of revenue. Freezing allowances achieves that quietly. Each year, inflation and wage growth pull more people into paying taxes. Economists call this the fiscal drag effect. It allows governments to collect more money without technically breaking any promises. But there's a moral question here. Should pensioners, many on fixed incomes, bear the cost of fiscal drag? For people who have already paid tax throughout their working lives, being taxed again on savings can feel unfair. As the budget approaches, all eyes are on Rachel Reeves. Any decision to cut ISA allowances or leave thresholds frozen will signal how the government intends to balance its books. For now, the message is mixed. The Treasury insists it wants to protect savers, yet the numbers suggest pensioners are shouldering more of the tax burden than ever before. The story isn't just about tax codes and percentages, it's about trust. Pensioners planned their retirements based on certain rules. Now those rules are changing, not through legalisation, but through inaction. For Britain's retirees, it raises a simple but profound question. Is saving still worth it?